Risk events video for the week beginning the 20th of July 2015. We've got a fairly busy week this week, but there is only one or two key risk events that we're keeping an eye on. There's one big one, which we'll come to shortly, but every day's got something going on, but it's not as big as it has been over the past few weeks. Last week was a massive week for data, lots of trading opportunities, lots of pips to be made, particularly on the Canadian dollar, also on the pound as well, that we were fully prepared for after last week's risk events video. So basically what we're going to be doing is the same kind of thing again. We'll go through the markets day by day and look at exactly what's going on and exactly how you want to be preparing to trade it. So we start with Monday the 20th. As you can see, there's nothing much coming out. We've got wholesale sales from Canada. These are expected to be much worse than they were previously. The previous, of course, was 1.9%. Forecast this time is only 0.1% the month-on-month figure. Now, this is a negative data point on a negative Canadian dollar. Remember, Bank of Canada cut rates in the last week or two. The outlook does not look rosy at all. There's speculation they might even have to cut again. And also, to go with that, the data has been dreadful. So, any negative data that comes out of Canada could be a further excuse to sell the dollar CAD, or sell Canadian dollar, buy the dollar CAD pair, obviously, as the Canadian dollar gets sold off. Now, last week we saw dollar CAD hit 130. That's what the key level. So basically, at this moment in time, we want to buy the dollar CAD on the dips. So every time it bounces back down from those highs, we want to be using that as a buying opportunity. And this wholesale sales figure could be a mild excuse to buy dollar CAD, sell Canadian dollar, because of course it is a negative risk event on a negative currency, so we could see further weakness on Canadian dollar, although it's not a major risk event considering all the other things that have been driving it. So, for example, the fact that, well, the thing that's driving Canadian dollar right now is the fact that the Bank of Canada have cut rates. They might continue to cut rates, and the big data points, you know, think things like inflation. Well, employment wasn't too bad, but most of the big data points haven't been that great from Canada. And in terms of the scale of things, wholesale sales not really that important, but nonetheless, it could potentially be a good one if it deviates negatively. I.e., if this comes out at 0 or below, could be another round of selling on Canadian dollar and, you know, look to buy the CAD pairs, particularly pound CAD, and of course that dollar CAD pair. Now, if we move to the next day, which of course is Tuesday, July the 21st, we can see here we've got the monetary policy meeting minutes from Australia. What do we expect from that? Well, we're not really expecting too much on the minutes. We are looking to see if the RBA are going to turn a little bit more dovish, whether anything that, you know, the discussions that they had at the latest meeting did take a turn for the dovish beyond what the markets are expecting. The general consensus is that the commodity-led currencies will all probably follow each other. So, you know, we think the Bank of Canada are cutting rates. RBNZ are hotly tipped to possibly cut rates this week, which we'll come to in a moment. And if that is the case, if the RBNZ do follow the Bank of Canada, the RBA, well, a lot of analysts think it's only a matter of time before the RBA go again for another cut, just to be on the safe side. So it'll be interesting to see what they talked about in that monetary policy meeting, just to see whether there are any hints of extra dovishness brewing at the RBA, and just trying to give us an idea of what's going to go on. Of course, the Aussie dollar, US dollar has finally hit that 75-cent level. If there is more dovishness, if there is more speculation of another rate cut to come from Australia, we can expect that pair to head down towards that 70 level quite quickly. But of course, we need that speculation to surface. We need something to give the market a reason to keep selling Aussie dollar, you know, over the next coming weeks or months. Apart from that, nothing else really much going on in the day. A little bit of data from, you know, Switzerland, China, New Zealand, and the UK, but nothing that's going to be particularly market moving. So basically, we move on to the next day, which is the 22nd of July, which is the Wednesday. Now, as you can see, there's a lot more kicking off on this day. This is the biggest risk event day of the week. First of all, we've got Australian CPI. Now, remember what we just spoke about. The RBA may be following suit with the BOC and the RBNZ, okay, going towards that dovish path now. So this CPI reading will be huge in determining whether or not that's the case. We saw it with New Zealand last week. Their CPI figure came out worse than expected. Not much worse, but still worse nonetheless. If the Aussie CPI comes out worse than expected, i.e. below 0.6, then that could lead to more pressure being heaped on the RBA, more speculation, and more economists kind of like, you know, maybe circulating the idea that the RBA could follow suit. So this CPI reading is pretty big, but only if we get a negative deviation. And the only reason it's so big right now is, of course, this kind of speculation that's just starting to simmer beneath the surface. It hasn't kind of took off too heavily just yet, but it is starting to simmer beneath the surface. And if it keeps going, if we keep getting bad data from Australia, it will only be a matter of time before it starts coming into the headlines and really moving Aussie dollar down towards that 70-cent level. Then after the CPI CPI reading, of course, we've got Governor Stevens speaking from the RBA. This could be a big week for the Bank of Australia, massive week for the Australian dollar, and of course, the expectation is for it to be to the downside. So if you are going to be biased going into the week, you're going to be biased selling Aussie dollars, sell Aussie dollar on the rally. If we just rally back up to that 75 level, that's a key psychological level to sell it from. And of course, unless we get a really solid, strong CPI above 1%, unless RBA's Stevens is really, really hawkish for some bizarre reason, that's how it's going to continue. And we expect these little key risk events, everything from the minutes to the CPI to Stevens' speech, to be maybe a little bit more dovish, maybe heap a little bit more pressure on the bank themselves to possibly cut rates again. But we'll see. We have to wait and see, but it's definitely one thing you need to keep your eyes on. After that, we've got UK MPC official bank rate votes. UK getting closer to a rate hike. Mark Carney said that basically the bank are closer than the market thinks. Last couple of weeks, really, the Bank of England, comments on the Bank of England have been quite hawkish. Is it going to be a 9-0? Probably is this time, but these votes we want to keep a very close eye on from now on, because the Bank of England are decidedly hawkish. That's going to keep the pound supported. The pound's another good currency to be buying on the dips over the next few weeks and months, but we want to keep on these minutes. As soon as these minutes change from 9-0, maybe 8-1, maybe 7-2 or whatever, we know the ball really is rolling and the Bank of England are really on course to hike that rate around the turn of the year. The question is, will it be in 2015, December, or will it be in 2016, January, February, March? Okay, the current expectation is March, but the Bank of England's comments have led some people to think it could be the tail end of 2015. So a little bit of speculation going on there, and these kind of votes will tell us how close the bank are. If they're all voting 9-0, wouldn't be too negative for the pound, and any sell-offs that do occur, we want to look for use that as a buying opportunity to buy on the dips, particularly against the weaker currencies. Not so much US dollar. Think about Japanese yen. Think about the euro. We definitely want to be buying the pound against those currencies if we do get any dips. And later on the day, probably the biggest risk event of the entire week. It's the official cash rate from New Zealand, the RBNZ rate statement to go with it. Will they cut? There's a very high probability, or there's a very high amount of speculation in the market over the last few weeks that the RBNZ will cut. You can see on the calendar here, the Bloomberg economists just about voted for the RBNZ to keep it the same, unchanged at 3.25%. But I can tell you, lots of other institutional sources have actually got economists weighing in favour of a cut. And that's the reason why the New Zealand dollar has sold off quite so heavily over the past 3 or 4 weeks, because this speculation has been circling now for around about a month. And if you look at New Zealand dollar, it's fallen into that. So great trading opportunity. If they cut, of course, we could see the New Zealand dollar, US dollar drop lower, maybe towards that 60-cent level. If they don't cut, we could see a nice relief rally on the New Zealand dollar, and we might want to buy that back in the very short term over the day or two following that announcement, because it's got a lot of ground to make back up. So we could see the market buying New Zealand dollars, and one of the pairs that's particularly interesting at the moment is Euro New Zealand. That's at ridiculous highs, 166, 160, testing 167 last time I looked. As soon as those big fundamentals come back into play, if the RBNZ don't cut, and this Greece situation settles down and everything gets back to normal with the Euro New Zealand's got a long way to fall, almost 3,000 pips off its lows, which is nothing fundamental has changed. Okay, even if the RBNZ do cut, they're still going to have a way higher interest rate than the ECB, and the ECB are, of course, implementing QE. So that's just one to watch. I'm not saying trade it right now. Euro New Zealand's a volatile pair, but it's one to watch over the next month or two for opportunities to sell back into that rally. And again, whatever the RBNZ do with the New Zealand cash rate here will be pivotal in the direction of the New Zealand dollar. So just to reiterate that, big one here. If they do cut, we could see the New Zealand dollar weaken further. If they don't cut, we could see quite a big relief rally because of the selling that's happened on New Zealand dollar and the anticipation that there has been in the markets for the RBNZ to act. So it's going to be a definite one. If you're around at that, if you're awake at that time, if you're trading that kind of event at that hour, this is probably the biggest opportunity to make some pips for the entire week. So keep your eye very closely on that cash rate from New Zealand. If we go to Thursday, July the 23rd, we've got some UK data, retail sales. We've also got retail sales coming out from Canada, unemployment claims from the US, and trade balance from New Zealand. Now, UK data, again, this could be a risk event you could trade into. Retail sales coming out, expected 0.4 versus the previous 0.2. This is a positive retail sales. Provided that the votes and everything else happened earlier in the week are, either as expected or positive for the pound, like I said, we're looking to buy the pound on the dips. This is a risk event you could possibly look to trade into because everyone's expecting a positive retail sales figure. Pound could very easily trade upwards into this figure. And if retail sales comes out better than 0.4%, we could see further upside on the pound as well. So very good opportunity on the pound at the moment. This is a risk event you could trade into or out of retail sales. You don't only try and make hundreds of pips. It's only retail sales. I would say 50 to 100 pips in that range, maybe 30 to 70 pips is more realistic range, trading into or out of that event, but definitely an opportunity, definitely worth keeping an eye on. Retail sales from Canada, well, this is expected to come in really positive, 0.7 versus minus 0.6. The core. The retail sales headline is 0.4 versus a previous of minus 0.1. Now, this is obviously quite good, and Canadian dollar is quite negative. So we don't want to trade into this. Don't want to buy the Canadian dollar into this because we're looking for negative deviations, of course. If we do get a negative deviation on this retail sales, that's yet another black cloud over the Canadian dollar, another black cloud for the BOC to contend with, and another reason why the rate cut was a good idea and maybe why they shouldn't stop cutting rates just where they are. So again, if we get the negative deviation, I would say this is definitely a risk event you could possibly trade out of. But you need to check the feeds. You need to check what the high and low expectations are. Find that low expectation. What's the lowest analyst forecast for this figure? If it comes out either at the low or lower, this could be an opportunity to sell Canadian dollar. Other than that, not really any opportunities on it. US unemployment claims, again, this comes out so regular, it's not really a market mover. It's not really anything that anyone's interested in. And then, of course, you've got New Zealand trade balance, which you expect to come in a little bit lower than previous. Again, it all depends what the RBNZ do. I think this data point will be overshadowed by what happens on Wednesday, to be perfectly honest. So we want to keep your all eyes on Wednesday. And I think what happens on Wednesday could set the tone for the rest of the week. So that's what you want to be paying most attention to rather than this individual data point this week. Now, if we go to Friday, July the 24th, we've got a slew of European data. But lately, European data has been overshadowed, first of all, by QE from the ECB. And then, of course, the Greece situation, which seems to be resolved. I'm not going to count my chickens just yet, but the news seems to be that there's been a kind of a bailout, the condition agreed. We need to keep a very close eye on that because obviously these things can change. But as we stand, as I record this video, things are looking a little bit rosier for the situation in Greece. But of course, you need to keep your eye on the feeds and make sure that that doesn't change. Assuming that that all is kind of done and dusted over the next week or two, European data, not quite at the point where it's going to be market moving. You probably will get some spikes here and there, but this isn't really tradable data just yet. Of course, we've got that QE program going into it. You know, we're expecting kind of positive data. We're expecting the data to start beating previous estimates now because of the impact of QE on the economy. So at the moment, we're in a weird situation with Euro data. It's not really something you want to be keeping a massively close eye on. You want to kind of see what happens, what it comes out as, but it's not really something I'd recommend to trade. And of course, you've got Chinese market flash manufacturing PMI as well. This is expected to tick a little bit higher than previous. Remember, big things going on in China at the moment. Stock market absolutely tanked over the last 2 weeks. Bank of China pumping liquidity in there like there's no tomorrow, desperately trying to shore up the system. It's getting desperate over there. It's getting very, very interesting. But at the moment, because of everything that's going on in the central bank news, you know, think of RBA and stuff like that, Chinese data generally only impacts Australian dollar in terms of our major currencies. And the big thing moving Aussie dollar, of course, is the central bank, the RBA. Will they cut? Won't they cut? So this Chinese stuff hasn't really been moving the markets as much as it normally would because of obviously everything else that's going on. But it is definitely important to keep one eye on. You know, if it looks like Chinese data is going to keep getting worse and the situation in China deteriorate further, that could be an opportunity to trade safe haven flows, which of course means selling the yen pairs, but I would be very cautious about that. It's just something to bear in mind. But I wouldn't expect it to move the Aussie dollar at this stage. Later on, we've got new home sales from the US. It's always a decent indicator, but it's expected to come up pretty close to previous. And of course, we are very positive on the US dollar at the moment after Yellen's comments and comments on the Fed, basically saying that a 2015 hike is appropriate. We're coming up towards the end of July. There's not many months left. There's only 3 or 4 months left of the year. So when will that hike come? It's got to come pretty soon if that, 2015 hike is true and those comments from Yellen are correct. So that's why everyone's getting really positive on the dollar. Kind of the time is ticking by. The rate hike is in a corner and we're approaching it. So you're going to get that positivity back in the dollar. And again, just like the pound, the dollar is a buy on the dips definitely right now, particularly against those weaker currencies. Think Japanese yen, think Canadian dollar. Think euro as well. They're the ones you want to be selling against the dollar, and that's going to continue over the next few weeks unless something drastic changes. So that's the risk events. Big highlight of the week, of course, is the RBNZ, but you also want to keep your eye on what's going on in Australia. That could be a tricky one as well. And of course, the